Alrighty. Let's get this party started. Good evening, everyone. Before I get into this, I just want to make sure that you all can hear me. So if someone can either unmute themselves or put yes in the chat so I can know that you guys can hear me before I get started, please. Okay, hopefully you guys can hear me. Can you guys hear me?
Yes.
Okay, cool. I was like, hold on. I don't want to be in here talking and y'all don't know what I'm saying. Okay, good. Folks are probably going to start trickling in, and if so, I may pause just to bring folks in as we get started with this evening of excitement and of education. Good evening, everyone. My name is Tanisha Broadway, and welcome to Think Like a Wealth Builder. I'm excited that you're here tonight. Thank you for being here. I'm really glad you took the time to join this conversation tonight. Tonight's not about rushing through anything. We're going to take our time. We're going to talk about programs. It's really just understanding how wealth is actually built, how it's kept using real estate. Now, before we kind of jump into it, I want to tell you a little bit about who I am and why I do what I do. This is the way that I teach. I've spent over the last 20 years in mortgage and financial services, working with first-time home buyers, self-employed clients, investors, families who want more than just a transaction, families that want to build legacy. Let me add somebody in this room here. I see more people are coming in here. So want to make sure nobody misses that. Awesome. So the thing is, what I've learned is that most people don't struggle because they're bad with money. Okay, so let's just put that out there. They struggle because no one ever explained the full strategy. Okay. People are taught how to get approved, but not how to protect what they buy, and definitely not how to pass it down. So, my role isn't just helping people get loans, it's more about helping people understand how lending and protection and legacy fit all together in this thing. Now, if something resonates with you guys tonight, we can talk strategy later, but for now, let's just build this foundation. So, when I say think like a wealth builder, what I mean is we stop and ask, can I qualify? Okay, we got that part. And I'm gonna do like a poll question here in a second. Um, yeah, I'm gonna do a couple polls. And but instead of that, we start asking what strategy makes sense for where I'm trying to go. Right, that's the next step. Focusing on acquiring, protecting, and transferring. That's exactly what tonight is all about. Now, who this class is for, let's move a slide along. Make sure I can do this here. Um, where's my little slide situation? There we go. Boom. Awesome. Okay, so this class is for homeowners who want to grow beyond one property, right? Um, it's designed for future homeowners. It's designed for investors, entrepreneurs, anyone who wants to use real estate as a long-term wealth tool. Now, now I want to ask a question. How many of you are in here? 11, 12, something like that. In the chat, if you could type in for me, like, are you a homeowner? Are you a future homeowner? Are you an investor? I just want to get an idea of who's on the call. So let's just take a moment to do that real quick here. So we've got, okay, where we at? Homeowners, not homeowners, investors, where we at, guys? Future homeowner. Okay, yes. Who else? Homeowners. Okay, excellent. Homeowner. Okay. Okay, we've got some homeowners on here. Any investors yet? Not yet? Is that why we're on the call to learn how to do this? Of course. Well, the reason why this class matters is because, most people buy property at some point in their life, but very few are taught how to build wealth with intentionality. Tonight is about showing you the options that exist and how wealthy families think about how to use them. So let's move to this next slide here. More people are coming in. Let me just add this person in. So think like a wealth builder. First question goes, okay, traditional thinking. Like I said, can I qualify? right? Yes, but we want to take this to the next level. Wealth builder thinking, what strategy fits my vision? Okay. Now, when we talk about acquiring assets, we talk about buying the real estate. Some of you are homeowners on here. There's a future homeowner on here. That's awesome. How wealth builders use lending strategically. Okay. Now, not everybody qualifies the same way. That's okay. Self-employed buyers, people with assets but not traditional income, investors scaling their portfolios. Wealth builders choose programs based on strategy, not on convenience. Okay. So with that being said, I want to talk about some programs. I want to talk about the different options that are out there. Okay. Again, not all borrowers qualify the same. For those of you who are homeowners on here, you guys probably all had different loan programs with how you qualified. But now we start thinking outside the box, right? We start thinking about the ways to utilize different programs to get to the next level. So the first program I want to talk about is the bank statement loan. You guys may have heard this before. It's been around for a while, and it's actually the number one option designed for self-employed and business owners, the bank statement program. Um, how we do it is we're using either business or personal bank statements, 12 to 24 months. And we pretty much average those out and figure out an income. The max loan to value is 90%. Cash flow matters more than tax write-offs, and it's ideal for entrepreneurs with variable income. Okay. Again, we allow for personal and business bank statements. And so what we're looking at is we're taking the deposits from the business statement, um, from whoever's looking to buy. So it's the deposits, and we're going to subtract out the business expenses. Okay, using a ratio, which I'll get to in a minute. And then we come up with a figure. Now, depending upon the percentage of ownership you own, that's the amount of income we're able to use for this program. So for instance, if you own like 50% of the business, then we're going to use 50% of the income from the bank statements. There is a minimum of 25% ownership required and 50% if you're using business bank statements. Now, if you have in like a usually large deposit, let's say the type of business that you have, you're getting, big chunks of money, which we define anything greater than 15% of the monthly income. We're basically just going to have to get a letter of explanation for that. Doesn't mean that we can't use it, but again, we're talking about guidelines here for those of you who may need to go this route or are interested in going this route. As far as other income sources, we do allow that as long as it's not employment. So if you're receiving alimony, or child support or rental income or trust or investment income, things of that nature. Now we can also use a P&L, a 12-month P&L. Okay. This is good. Let me move on to this slide. This is once again for borrowers who have their own business. Now, the restrictions for using a 12-month P&L is the same as the bank statements, except that the minimum ownership is 50%. Now, on this program, the business should be in existence for 2 years. Okay. And then we need like a business narrative, like what's the business about? What do you do? Kind of written out. And so, just like the bank statement option, we use a percentage of the income that the borrower owns of the business. So, again, if you own 60% of the business, we use 60% of the income. And this has to be prepared by a CPA. Okay. So, again, bank statements, if you get a bunch of money, you can't use tax returns, there's an issue there. This is the way we're going to go. Now, I want to segue real quick because it's important to discuss like what is it that I'm even talking about, right? Like regular loans and then non-QM. What does that mean? Let me break this down. So I want to clear something up because some of you may be thinking like, oh, are there stated loans out there, right? Those loans that were like around back in the day. Okay, so we have like non-QM, which is, well, QM means qualified mortgage. So we have a qualified mortgage and a non-qualified mortgage. Okay, non-qualified mortgage doesn't mean it's like a bad loan, and qualified mortgage doesn't mean it's a safe loan. It's just different rules for different people. With a standard like qualified mortgage, they follow very specific guidelines, and this was put into place back in 2008 with the housing crisis. Okay, you remember back then, for those of you who bought back then, those liar loans, that was a thing, right? A lot of people lost on that. It was terrible. So the rules were designed to make sure that borrowers have the ability to repay the loan, right? You remember those loans where like you could just basically have a pulse and That was it. Okay, so they came up with these rules. Now, qualified mortgage loans typically require what I'm sure you guys are familiar with: W-2s, income, tax returns, predictability, fully documented. Okay, debt to income ratios, there's limits for that, like no interest only, no flexible alternative documentation. Now, these loans are really good for people who have like traditional jobs or steady paychecks, things like that. But there's a problem, right? It doesn't work for everyone. So a lot of financially strong people just don't fit into that box. So I call like the non-QM space my outside of the box options. You got to have those tools. Self-employed business owners, entrepreneurs, investors, people with significant assets but complex income. It's not risky. It's just that their picture is different. In fact, I find a lot of buyers who are able to go with the non-QM happen to be a lot stronger than like a QM. It's interesting how that works out. So instead of relying on like W-2s and tax returns and all of that, we're looking at like the full picture: bank statements, assets, rental income, interest only structures, higher debt to income ratios, portfolio based type of underwriting. Okay. Now, non-QM loans or outside the box loans, so they're still underwritten like a traditional loan, like it has to go through underwriting, the whole process. They're still required documentation. It's just different. They still have risk, right? They're just I'll say flexible. Okay. Now, how wealth builders think about this is they don't choose a loan based on labels. They choose a loan based off of the strategy, right? The cash flow, the asset protection, the long-term goals. And sometimes that's a standard mortgage and sometimes that's a non-QM mortgage. It just depends. So the next option that we look at is the asset depletion loan. Okay. Have you guys heard of that? Okay. Let's talk about that. So this is using assets instead of employment income converted into a monthly income, right? So you got a lump sum of money, and then that's turned into income. So this is good for retirees or high net worth clients. Okay. Um, so let me give you like a real life way to think about an asset depletion. Let's say there's a family, like you guys are doing the right thing, created a trust as part of your legacy plan. We're going to get into that. And inside the trust, there might be some cash from like an inheritance or life insurance proceeds or something like that. And over time, the next generation ends up with this large sum of money and they want to buy a house. Now, most people immediately think, oh, I should just buy the house cash, right? And you can, but that's not always the smartest move. This is where the asset depletion loan comes in. So instead of, is there somebody in the, let me see here. I thought someone else was trying to come in. Okay, just triple checking. So instead of spending like all the money, right? The lender, what we're going to do is we're going to look at that assets and we're going to basically say, okay, we're going to treat this like income. We're going to spread that assets over a long period of time, like 30 years. And then we're going to calculate that and create a mortgage from that, qualify you for the mortgage on that. So you pretty much have the assets working for you without draining the trust money. Okay. And I want to talk about that in a little bit here. So what that means is you can buy a home, right? Get approved for financing, still keep most of the money where it belongs, either in a trust or it's invested somewhere in an index strategy or something like that, which I'll talk about as well. For example, let's say someone's got 1.2 million, right? We may only use a portion of that to calculate and qualify for income. So then the other majority of that can be put somewhere else. That's big, right? That's how wealth builders are thinking. Okay. Instead of all the cash now, we think how to preserve this for long term, how to keep assets liquid, super important, how to let them continue to grow, right? How do we make sure there's something left for the next generation? It's about passing on wealth and not debt. That's what asset depletion does. Okay. It lets you use the legacy without consuming it, pretty much. Okay. So again, assets are held inside of a trust, an inheritance. We convert that amount into income, just to recap. Again, no W-2s, no tax returns, none of that stuff is needed. Now, let's talk about, I think, in my opinion, this is one of the best options for anyone looking to buy property and become an investor, the DSCR loan. Okay. It's pretty phenomenal, like what it does, and I'm going to get into it. So check this out for a second. The property, right, qualifies you. Doesn't matter what your income is at all. Approval is based on property income. Doesn't matter what your debt to income ratio is. Okay, it doesn't matter if you own other properties. It's designed to focus on the rental income. Yeah, it's pretty dope, right? So it's one of the most important, I think, biggest tools that an investor can use. Again, it's not designed for primary residences, by the way. This is an investment loan. Okay. But this is where we shift. So just to let you know, the DSCR means debt service coverage ratio. Okay. Don't get caught up in the name, right? It just pretty much means is the property pays for itself. Instead of looking at your personal income, we're looking at the property income. So how it works is the lender, we're going to compare the expected rental income against the monthly housing payment. That's what it is. If the rent covers the payment or comes close, then the loan may qualify. That's it. So no W-2s, no tax returns, no personal debt to income ratio, none of that, right? So who is this for? Okay, so it's built for real estate investors. It's built for people buying rental properties, short-term or long-term rental strategies, investors scaling beyond what their personal income is going to allow. Now, think about that for a second, because every time you buy a property the traditional way, you're adding that loan to your personal profile. And your profile can only hold so much, even if you've got great income. I mean, you can only carry so many mortgages. This is how people move from one or two properties to a portfolio by leveraging this program. Okay. Now let's be clear, DSCR loans are still underwritten. Okay. They still look at credit, reserves, the property. So you definitely have to have qualifying credit to use the program. But again, this is based off of the rental income. Now, wealth builders don't want every property tied to the personal income. So this allows a separation of personal finances and investment. Okay, again, portfolio growth without income ceilings. You can buy an unlimited amount of properties using this program, like an unlimited amount, and all over 50 states too, as well. And I can help you anywhere in the country. Okay, so this is like scalable without stress. Now, a little bit of background about this program, just so you're aware. So, this loan structure, it didn't start in the residential real estate arena. It was originally used in commercial financing when lenders focused on income more so rather than the property itself could support the debt. And so as the market evolved, investors decided to build their portfolios outside of this way. And they realized that in order for regular individuals to buy more properties, they had to figure out a way, because once again, like I said, having too many mortgages on your credit, that's you're only going to be able to own a couple of houses. Your debt to income ratio is going to get strained after some time. So now they added this into the residential financing world, without the W-2s and income and all that stuff, and lenders have adapted. Hope someone is joining. Let's see. Admit them. Yeah. And so now you can buy a 1 to 4 residential investment space. And instead of asking how much do you make, the question became, can this property pay for itself? So now if you're thinking it's time to buy an investment property, the next question is, how do you qualify for this using this program? Okay. So we look at one primary ratio, rental income divided by the monthly housing expense. The monthly housing expense includes principal, interest, taxes, insurance, and an HOA if that's applicable. So this results in your DSCR ratio. So let me paint a picture real quick here. So let's say your rent is $2,500 and the mortgage payment is $2,500. So that's a DSCR of 1. Some lenders like strong ratios. Now I have a different, like I'm able to broker things out, right? So I have all the options. So like a 1 or 1.5, meaning that the rent may be a little bit more than the mortgage payment. Now, in some situations, it could be a little bit lower, where maybe the rental income doesn't cover all of the mortgage payment. There's options there too. Again, the focus stays on the cash flow, right? Not the income, not the paychecks. So if the ratio is, let's say, 1 to 1 or higher, the rent covers the payment. If it's higher, the property has cash flow. Again, If we do a lower scenario, it can happen, but there's going to be some adjustments, 100%, right? So again, instead of proving you can afford the property proves it can support itself. So there's other options too when you're using this, like long-term rentals, short-term rentals. So with a long-term rental, let's look at that scenario if that's something you want to get into. I need an executed lease agreement and then the market rent from an appraisal. So the appraiser is the one who's going to determine, okay, does this rent make sense? I have a client right now looking at a property in the Oakland area, and houses are expensive out there, right? And so interest rates are going to be a little bit higher on this type of product. It's the nature of it. And so is it going to make sense, right? When we look at that rental income, is it going to support that mortgage payment? I mean, it'll come close, right? You've got to be aggressive. A good idea, if you're looking at this product, is multi-units, right? A 2 unit, a 3 unit, a 4 unit, because now you've got multiple rental payments, but just that one mortgage. So of course you're going to have a one DSCR or even better than that. Okay. Short-term rentals. You can leverage that. This is cool. So they're qualified a little bit differently using market data, comparables, properties, income projections, things like that. But you got to be tricky on those short-term rentals, different areas. There's like rules. So if you have a real estate agent that's looking at those properties for you, like bring them to me so we can kind of figure out if it'll work or not. Okay. Um, in fact, short-term rentals, when structured properly, can produce higher income than the long term. So, I mean, it's a good deal if you can find one out there. Okay. Again, let's talk about a couple little guidelines. So, minimum credit score, I'm going to need a 660. Let me take that back. I can do it at a 620. The higher your credit score, just like in any other situation, the better the interest rate, the better the terms. Okay. But a 620 can get your foot in the door. You're typically going to need 20 to 30% down. So this particular program is for someone who's got some capital. That's what this is. If you have access to money for the down payment and you've got eligible credit, then you can buy as many of these and use this loan as often as you need to, unlimited all across the country, except for New York. Okay. Now, 660 credit score, you're going to get better pricing. So between that 620 and 660 credit score range, it'll work. But if you want to get like way better pricing, you're going to need to get to a 660. Very important. A 700 credit score is needed for a first time home buyer, okay, with 30% down. So, like I said, this is an investor type of loan. So if you're a first time home buyer, you can jump into an investment strategy with this particular loan program, but those are the rules. 700 credit score, 30% down, and the DSCR must be 1.15, which means that the rent's got to be a little bit more than the mortgage payment. Okay. There's a minimum and maximum loan amounts too. We can get into that. No 30-day lates on your mortgage payment. So you've got to been paying your primary residence or your other mortgages on time. Although we're not adding your other mortgages into the equation. Okay, we're looking at the scores, but you still have to you can't have any mortgage lates in the last 12 months. That's the main thing. Okay. Depending upon the strategy, DSCR also offers interest only payments. Yeah. Yeah. So that payment's going to be much cheaper if we're looking at an interest only option coupled with that. Fix and flip or fix and rent options. Now, again, like I said, you can use this program and buy unlimited property. So, like, think for example, it's expensive in California. We get it. But where is it not expensive? Other parts of the country, right? So maybe 20% down on 500,000, right? That's 100 grand. Maybe not everybody has 100 grand lying around. But if the property is 160,000 and you've got 20% down, that may open up more opportunity, right? Think about that. How many properties could you buy out of state or somewhere in the South where the property is 150,000, 120,000, you only need 20% down and an eligible credit score, and you can just buy those up, right? That's the way to do it. So again, looking at this option, it's a wonderful, wonderful way to start building your portfolio. Okay. So we've talked about how to acquire the real estate. We know how we're going to get the real estate. We have options. We've got bank statements. We've got all of the things. But now we want to talk about protecting what you've been building. Because This class of think like a wealth builder is more than just acquiring the properties. It's like, now what do we do?
Mm-hmm.
Okay. At this point, again, we need to shift and focus on preserving this, again, passing on wealth and not debt. So this section is about protection. Now, why does protection matter? Let's get to the next slide here. Am I stuck? Oh, I might have froze a little bit here. Oh, there we go.
Let's have them believe it and check what you just built.
Why protection matters. There we go. Okay. Why does protection matter? Right? Why do we need to focus on that? Because as your assets grow, so does your exposure. That increases. Okay. Second, more leverage means more responsibility. All right. So financing is a powerful tool. Yes, but every property is going to carry its own level of obligations and payments and people depending on that. Important. And then third, real wealth builders don't plan for a best case scenario only. They're planning for life events, illnesses, okay, disabilities, unexpected losses. The difference between owning assets and protecting legacy, super important. Now, why investors need protection? Well, let's talk about that. Number one, multiple properties increases exposure. Number two, well, each additional door is gonna exasperate that risk. Okay. Number two, one life event can affect your whole entire portfolio. So it's not just the one mortgage we're looking at. We're looking at all of them at one time. Without it, so what happens? Families are forced to what? Quickly react. Okay. With it, assets stay intact and income continues, and there's no issues there. So here's the uncomfortable reality for most people that people don't even talk about. This is some real stuff right here. Did you know that roughly half of Americans don't have life insurance? Yet millions own assets, homes, investments, properties, businesses, equity, right? So let's talk about what happens when someone builds up a real estate portfolio, but they don't protect it. Let's go to the next slide. Okay. So let's paint a picture. An investor owns 3 rental properties, and then unexpected happens. The variables, illnesses, or God forbid, right? You taken out of here. So if protection is in place, right, mortgage protection keeps the properties intact. Without protection, what happens? That assets, it likely could be sold, often quickly, often with a loss. Okay. Because if something happens to you, let's be real, mortgage don't stop paying. Okay. Then payments don't stop. Property taxes don't stop. Insurance doesn't stop. Tenants are still living there. Okay. Families still need income. So without proper protection, the assets often end up forced into a liquidation situation or tied up in probate. You guys know that word. Okay. Or sold under pressure, right? Or transferred with chaos. The family's trying to like navigate what's happening with you and then also with the properties. The wealth that you've worked so many years to acquire and build can disappear in months, just like that. And that's not legacy, guys, that's exposure. So it's important to understand that. Okay, now my role in this protection strategy, this is where I kind of shift my hats a little bit here, right? So I'm both licensed as a mortgage and financial strategist, 20 years in the game, which allows for like one coordinated conversation. So this is about really building this wealth here. We're serious here. So my approach is education first. You're here tonight. Congratulations, way to be here. It's strategy driven. So we're going to talk about all the options that you need to get to where you're trying to get to, and then fully aligned with the assets that we're building. In addition to helping my clients acquire assets, I help them protect what matters. So again, your legacy, your loved ones, and the properties that you've built so hard to acquire. Okay, now let's talk about the protection piece, mortgage protection. Homeowners on here, do you have a mortgage protection policy in place? One of the most important tools that you can have is a mortgage protection policy. Okay. Mortgage protection is designed to ensure that if something happens to you, your properties don't become a burden to your family. Instead of asking what happens to the houses if I'm gone, we're able to say the mortgages are covered. That means properties don't have to be sold, loved ones aren't forced into financial decisions that are uneasy or under stress, and assets stay intact. What about living benefits? Have you guys heard of that? Okay. Today's strategies go beyond just traditional life insurance. I want to be clear. This is where living benefits, meaning while you are alive, you can access these benefits. Okay. Living benefits policies allow you to access the funds while you're alive in the event of critical, chronic, or terminal illness diagnosis. Even COVID was a reason why folks were able to leverage the funds, their living benefits, to pay their bills and not skip a beat. Again, that means protection doesn't only show up when someone passes, it shows up when life happens. Okay. Again, it's going to help you cover those mortgage payments, medical expenses, income gaps, and prevent assets from being drained. So instead of your real estate portfolio being liquidated or because of a life event, it's supported, and now the generational wealth continues. Okay. Very, very important. Let's talk about transfer, creating legacy and continuity. This is an important one. So yes, you're building this legacy while you were here, right? You're working hard to do that. But then when it's time for the Lord to take us up on out of here, what is that plan? Do you have a plan in place? Okay, so this is where we move from protection to transfer, because wealth is not complete if it doesn't outlive you. Without a plan in place, assets can be delayed or lost. And wealth builders plan for continuity, not just ownership. So why transfers matter? Well, let's talk about it a little bit here. If there's no plan, then once again, you're struggling, right? Wealth is not complete if it doesn't outlive you. Without a plan, again, your assets can be lost or delayed. And again, it's about making sure that there is a plan in place. The worst thing that you can do is not have a trust set up, and then something happens, and then now your properties end up in probate, or you end up losing them, right? So again, legacy isn't accidental, it's by design. It is designed. You have to design it, okay? Because why? If you don't plan, the state will. Mm-hmm. Assets without a trust go through probate. This is what it is, okay? You don't have that set up. So here's what's really cool. I have one of my carriers that I work with. I can provide a free will and a free trust. Absolutely. So if you don't have a will or a trust in place, see me, because we can get you set up with one. Probate causes delays. It costs money. Thousands of dollars you're going to pay to deal with probate, okay? Loss of control. Planning keeps decisions in the family. Again, when there's no plan in place, probate is going to step in. Someone else is jumping in. It's a little late on the call to be jumping in. It's okay. Trust, they're going to allow, when you have a trust, you keep all the control. You can write out in your trust how you want the money to move, how you want the houses to move. When does that make sense? Like, let's put on like a next level thinking when we talk about trust and talking about how your assets are going to move around. Okay. I'm going to move to this slide right here. The Rockefeller principle. The Rockefeller principle. You guys know who the Rockefellers are. Now, I'm not talking about Jay-Z and them. No, I'm talking about one of the wealthiest families in our history and what they understood. How to not just pass down assets, but how to pass down a system. The Rockefellers. You guys know them. Okay, let's stretch this conversation a little bit because I want to kind of take your guys' mind somewhere a little. We're talking about what wealth builders do. Okay, next level thinking. So what if I told you that protection isn't the end of the strategy, right? It's just the engine. What if instead of just buying properties with traditional capital, okay, you use financial services to help you buy more real estate while your money continues to grow? This concept isn't new. In fact, this is what the Rockefellers used, okay, to build fortunes long before banks came into the picture and started dominating lending. Okay, families like the Rockefellers, they understood something powerful. The wealthy just don't use banks, they become the bank. And here's how that looks today. So many investors don't rely, really, you know what? They don't realize that you can take This might blow some of your guys' minds a little bit. You can take liquid assets and put it in a structured account like a fixed indexed annuity strategy or something like that I can provide you with, where your money has the potential to grow tax deferred, and you can get double digit interest on it, like 15%, 25%, 30%, even in some situations, uncapped interest, not tied to the stock market. So I'm not talking about you putting your money in the markets. Now, I'm not saying the stock market is a bad thing. Do what you do if you want to play that game, but I'm talking about risk-free opportunities where you get all the upside of the market and none of the downside. So instead of pulling that money out to buy a property, you can borrow against it, and then the money that you're keeping in there, your principal balance, keeps gaining interest. You are your own bank, right? The bank of you. That means your principal stays intact, your money continues to compound. You guys have heard the term compound interest. You know what that is? The rule of 72. Okay, think about it like remember back in the day how when we were in school we had the science class talked about the cells splitting, right? You have one cell, it splits and there's two cells, and then it's four cells and so forth. So that's what your money can do in the right vehicle. Okay. The banks do it, by the way, and I know I'm a lender, but I'm not a bank. But you put your money in the bank account, the banks turn around and they go put your money in BOLI, bank owned life insurance. And so they give you maybe a high yield interest account, maybe 3-4% at the most, but they turn around and they're getting the 15-20% interest, right? So instead of you putting your money in a bank, put your money where the banks put their money. And then you leverage that money and you buy more real estate. That's the game, peoples. Okay. It's called infinite banking. These strategies have been around for over 100 years. Okay, this is the part that most people miss though. So again, and just to be clear, you don't need a large sum of money to start saving and building, because let's be honest, it's tough to save money for those of you who are not investors yet and you're trying to figure out, how do I get my foot in the door to start investing? Like, it's hard for me to do X, Y, and Z, let alone save money 20% down. Well, you got to start somewhere. So if you're saving your money in a vehicle where you can get that type of interest, you're a step ahead of the game. Okay. Great returns you can get on your money. We can talk about that. I can help you set up that account. Super easy to do that. Again, so instead of saving in places where money just sits, you're saving in a way that gives you options, access to the capital, protection. Because remember, it's got living benefits attached to it. So it's growing in these vehicles, right, where you're getting this interest, but then it's got living benefits. So if you get hurt, you get sick, something happens, now you can access the legacy benefit, the death benefit, while you're alive, to cover your bills, do you see how we're putting this whole thing all together here? Okay. This is what this is. Again, so brings me to my next slide, bringing it all together. I didn't even know that was my next slide. I guess it is. So we're using these different loans to acquire more real estate. The bank statement loan, right? We're using the asset depletion. We're using the DSCR, okay, which again, I think is one of the most powerful tools out there, loan-wise. Trusts, transferring assets, making sure that you have your wishes documented, detailed in a trust, right? This is the wealth builder system. This is making sure that you are fully dialed in on all levels, okay? We're going from education to execution. So education, this is tonight. We're creating the awareness, okay? Strategy creates a direction and execution creates the result. So who's ready to start executing, right? And building some real wealth? Next steps. Everybody on this call needs to schedule your time with me. That's my QR code for my calendar. Scan it. You're also going to get an email with a link on it and you can get on my calendar. And if you have a mortgage, we're going to review it. We're going to add mortgage protection. If you don't already have it, we're going to definitely add that into your strategy. And we're going to talk about how we can buy more houses. Okay. What we covered tonight was super intentional. Everything was intentional. We talked about, again, how are wealth builders acquiring assets? We talked about, transferring them. It's not accidental, but it's by design. The biggest takeaway I want you to leave with tonight is wealth isn't built in one decision, you guys. Okay. It's built with alignment. Okay. Alignment between lending protection, and legacy. Now, most people are only ever shown like one piece of the equation. That's how it is. So my role is to help you guys see the whole strategy so that you can make an informed decision to support your long-term goals. Okay. So tonight was about education. And if this expanded how you think, if it helped you see options that you didn't know existed, then it did what it was supposed to do. I did my job tonight. Okay. As a matter of fact, if you're ready for the next conversation, the next strategy session, it's time to take some action now. Some people will take action right away, and others will take time to process. And either way is okay. There's no pressure here. I just want you to know that I'm here to help you guys get to that next level of wealth building. And I'm excited to connect with you guys. So at this time, I'm going to open it up for any Q&A that you may have at this time. I know on my flyer it says Q&A. I know I covered quite a bit, probably was a lot. But hey, you know what? This is what we're here to do, is talk about this stuff. So let's see if there's any questions. They evade taxation, give taxes, foundations that are all projected from outside forces and minimally tax. Are you talking about, I don't, oh, are you talking about the Rockefellers? I'm assuming that's why you put that in there. But oh, let me go to this slide real quick here too. That's my contact information, you guys. Oh, you're very welcome. My phone number, email, website. While saving for a new home, would you say it's more beneficial for us to become our own bank first? 100%. 100%. Yes. While saving for a home, would you say it's more beneficial for us to become our own bank first? Okay, you guys. So that is like the most powerful question, probably one of the most important questions that you could even ask yourself immediately. Yes. Yes. If you don't have, the 20% down and you want to, acquire that, becoming your own bank and starting a plan to where that you can access that capital is what I'm talking about. So I can help you create that account to where you can turbo boost your savings to be able to access that capital and use it for real estate. 100%. Yeah, great question. Yeah. Any other questions? You guys were quiet tonight. So I am in Elk Grove, my home office, and my office is in Roseville. However, I do most of this via Zoom because I work with everybody across the United States. So what we can do is set up a time where you can jump on my calendar. Coming back in, where you can jump on my calendar and we can set up a session and go over your specific situation via Zoom. Absolutely. Awesome. Awesome. Okay, cool. Let's take some next steps then. So in the morning, matter of fact, I'm going to do this right now. I knew I wanted to do something. I'm going to put a link. Let's see, where did I put that at? Here. I have a link. I'm going to put it here. So this link should take you to a Google form that you can answer some questions about what you're interested in doing, your next steps, and put some times on there. I'll reach out to you, or in this email that you're going to get from me, a follow-up email, my calendar link is going to be on there, and you can select a time that works for you, and we can hop on a Zoom and start customizing your plan. But again, it's been a pleasure. First-time home buyers, if you are that are on here, this is a great program. These are great programs if you're looking to jump right into investment opportunities. However, if you are wanting to get your foot in the door and utilize like a program for a first-time home buyer opportunity, that's another call. Matter of fact, I have that class on February 9th. You'll get an email about that one as well. So if you have family or friends that are looking to buy, and don't know where to start, send them my way. This is what I do. I love what I do. I love educating. I love getting people in position to build wealth. That's like my passion. So you're very welcome. Awesome, awesome. So I look forward to seeing you on my calendar, Delcy. And if anyone has any more questions, anything else, you guys, I know, like I said, I Covered a lot today. It was a lot. Okay, cool. Well, let's buy some properties, you guys. Let's invest. Go talk to your real estate agents. Go tell them that you're ready to buy some investment properties out of state. Tell them to find you something cheap. Then call me, and we'll put a loan in. Yeah. So those are for those who are ready to buy something. Everyone that's on here needs a living benefit. Everyone that's on here needs living benefits. So if you do not have a living benefit policy in place, you have to get on my calendar. So we got to start there at least. Okay. Make sure that you are protected and your family's protected and all of the wonderful things that you need in order to be um, fully in alignment with your wealth goals, with passing on wealth, not debt. I say that all again. That's what you 100%. That's what I'm saying. Of course it is. We all have to get one of those. It's the best thing. And for your kids too. By the way, I will put that out there. I do this thing called Million Dollar Baby. So any parents that are on here, you have children, and you're looking to get them set up for by the time they're our age, right? They'll be a cash millionaire that they can leverage and buy real estate too. Set them up now, guys. For less than a cup of coffee, I can create the same type of account for a kid, okay? And you, since you're the parent, you can leverage what's in that account and buy them things like a car or college or down payment on a house or whatever you need to, but get the kids set up. If you can do anything for your kids, get them set up with something like that. So I want to put that out there for any parents or grandparents. That's important. So I can help with all of that as well. Yeah. And so, with that being said, it looks like we're just a little bit under an hour. That's what I wanted to accomplish. It's been a pleasure connecting with each and every one of you tonight. I look forward to assisting you on your wealth builder plan. And way to start thinking like a wealth builder. That you can tell yourself now, you thinking like a wealth builder. You attended this class tonight. I will be running this back next month. So if you have friends or family who you know would benefit from this information, make sure you tell them about this class and we'll have this going again. And we'll go from there. You are very welcome, you guys. Well, you have a blessed evening, everyone. I look forward to connecting with you guys. Take care. Bye.